It's looking like you're not going to be able to complain if your favorite DeFi project gets into a head-on collision with regulation because the central banks are already telling you exactly what they're going to do. Ready? Let's go. I wish I could say that the ideas we're about to discuss coming out of the Bank of England are just the position of one set of central bankers, but I'm afraid all the central banks are probably thinking the same thing. It's just that the Bank of England is saying it the most loudly. So at least we get a little peek at what's probably coming for all of us. The Bank of England starts out by telling us, hey, in the current legacy system, there are basically two types of money. There's central bank money, which is available to the public as cash and available to commercial banks as central bank reserves. And there's commercial bank money. These are deposits in commercial banks, which are basically claims on that bank. And this commercial bank money is created when commercial banks make loans to households and companies, the real economy. And this commercial bank money relies on efficiency and the confidence it can be exchanged for central bank money, right? It's actually pretty easy to use commercial banks. Using your debit card at the grocery store is pretty easy. It's very efficient. And you have a pretty high level of confidence that it can be exchanged for central bank money in countries where the legacy financial system is working well. For instance, in the UK or in the US, in Canada, these are countries where you can have a high level of confidence that you can turn those claims on the bank, the amount you have deposited in the bank, into actual central bank money. Here's where the Bank of England starts talking about crypto. They say, hey, there's this thing we're going to call new digital money. And here's where they're going to engage in an intellectual conceit. They're going to say that new digital money does not include Bitcoin because Bitcoin is not anchored by an asset like sterling. And by extension, they use Bitcoin as an example, but they're talking about all of the public chain cryptos that aren't stablecoins. They say, hey, they're not anchored by an asset like the pound sterling. So we're not going to call that new digital money. Our definition of new digital money is pretty much just going to be things that meet the following two criteria. They are denominated in pound sterling, and they're not created by lending as in commercial banks, and they're anchored by something. They're going to say these could be two different things. New digital money is really just CBDCs or private stablecoins, right? So this is a pretty big intellectual conceit because they're immediately ruling out the scenario that public chain cryptos, actual cryptos, not stable coins like Bitcoin, for instance, or ADA, those couldn't possibly replace the base currencies, right? Pound sterling is going to exist in all scenarios we're going to talk about. And in fact, the only new digital monies we're even going to address are going to be the ones that will ultimately be backed by the pound sterling. So that's the initial intellectual conceit that you just kind of have to accept in their evaluation. So a lot of this may not apply to the base currencies on any blockchain, but it certainly does apply to private stablecoins. Pretty much any stablecoin you can think of in crypto. So they say there are two necessary criteria for these types of new digital money. Again, that's CBDCs or private stablecoins. Two necessary criteria for them to endure. They have to be trusted as a store of value and accepted as a form of payment. The Bank of England says that necessarily means they must be exchangeable for current money. So they've kind of framed the discussion to say, hey, we're not even going to talk about any of this crazy crypto stuff you guys are doing unless it's exchangeable for current money. Your base always has to be sterling. It always has to come back to sterling because we're the Bank of England. That's the business we're in. We're not even going to talk about these possible universes where your base currency is a crypto and you guys aren't even touching the fiat system. So that we're all on the same page, let's look at some CCTV footage I've procured of a regular commercial bank next to a central bank, right? Here is the central bank. And for some reason, they wrote the letter CB on top of the central bank, just so if we were looking at, CCTV footage, we could tell what it is. So the central bank, it interacts with, the real economy people, households, businesses through cash, right? We can say cash. And that's usually like, through some treasury department or something. So we don't think of it as being the central bank directly, but it's through treasury. They also interact with commercial banks. We'll say COM, since CBD is the same acronym here. Commercial banks through reserves, right? Through their reserves. So they interact with commercial banks, right? And here's where the legacy banking system gets so complicated, right? The way commercial banks interact with the public is through this weird system, right? The commercial bank, they make money by making loans, right? They have a bunch of other little income streams, but they make a lot of money through making loans. So what happens is, normal person in the public, they make deposits into the bank, right? They make deposits into the bank, and the bank sometimes even charges them for holding that money, right? Which is ridiculous. I'm sure you all already realize this. So they make deposits. Money comes into the bank. The bank doesn't really have to pay for access to that capital. Like I said, sometimes they even charge the person making the deposit, but the person making the deposit, is just like happy the bank is holding their money. But the bank doesn't actually hold their money. They send it to somebody else in the form of a loan, right? Loan. And as you all know, this is fractional reserve banking. So while they may have just received a deposit of, $1, they're going to loan out $20. And that is actually how the money that the Bank of England here is calling commercial money, that's how commercial money gets made. Commercial bank money gets made. It's created when banks make loans to households and companies. That's how it works, right? So this is the relationship they're talking about. And here's where things are going to get a little bit complicated with stablecoins. And here's part of why the central banks really care about the stablecoin issue. So the Bank of England says it straight out. Stablecoins could result in a higher fraction of money in the economy backed by higher quality liquid assets rather than by loans to the real economy, people and companies. This may reduce the efficiency of credit provision in that fractional reserve banking is easier. So I was paraphrasing parts of that. That's not an exact quote, but they're basically saying that. So when you look at this legacy system, like this loan, this one right here, this is awesome for the bank to make, right? They'll make this loan all day long, right? They didn't even have to access the capital for that loan. They didn't have to come up with $20. They just sort of invented out of thin air. It's fractional reserve banking, right? We just kind of invent out of thin air the $20, and it's just on a ledger, right? It's just on our ledger. It's it's accounting. And that $20 loan is made, and there we've created like $19 worth of new commercial bank money. That's a great business, right? Why is the banking business so good? This is why. They took in $1. They didn't even pay for access to that capital. Then they make a loan of $20, which they didn't even have. The problem is, as soon as you start using stable coins, right? And everything's, say it's a private stable coin, everything's on a ledger. We know where all those stable coins came from. We know what accounts they're in, all that good stuff, right? You've got a problem, because if somebody makes in the stablecoin universe, right? If somebody makes a deposit of $1 of the stable coins, and then they want to make a loan over here, right? The commercial bank, if they're not the ones, they're no longer running this ledger. This is on a blockchain, right? If it's on a public blockchain that's accessible, the bank can't say, hey, we're lending this guy $20. That's not the way cryptos work, right? If it's a crypto-based public chain stablecoin, everybody's going to look at the blockchain and say, yo, you only had $1. You don't have $20 worth of a stable coin to loan out. That's a problem for the bank. So in this stablecoin universe, right, if it's a public blockchain stablecoin, really what happens is the bank, GASP, has to actually pay somebody else. They have to pay. I don't know why that line's there. They have to pay somebody else. It just kind of appeared. I think it copied and pasted another line or something, but they actually have to pay somebody else for the $20 worth of stablecoin, right? Now all of a sudden, this little transaction right here, they have to pay for access to that capital. Now for them to make this $20 loan right here, it's not like them taking a deposit, which they get for free, or maybe even they charge for. Now they're paying for that $20 worth of capital in order to make this loan down here. That means they're going to charge a lot more for this loan right here. And this is what the Bank of England is worried about. They're worried that this loan right here is going to become much more expensive for this individual seeking credit down here. So of course, taking all this stablecoin stuff together, the Bank of England, has deemed this a possible systemic risk. And they have a committee that deals with possible systemic risks, the Financial Policy Committee, which looked at stablecoins in 2019 Q4 and set out its expectations for stablecoins to ensure public confidence in stablecoins as a means of payment and store of value to the same extent as commercial bank money. So the bank's models, when they've modeled out, this report is the bank modeling out what could happen with stablecoins, and the bank's models are conditioned on stablecoins meeting the Financial Policy Committee's expectations. So they've created a scenario based on this model. In this scenario, 1/5 of household and corporate deposits migrate to digital money from the legacy banking system. So we're talking about 20% of the money leaving the legacy banking system. Because in the last example we showed, right, they're saying, hey, stablecoins might make it a lot more expensive for banks to make loans to people, and people may seek out cheaper sources of credit, right? If the banks are all charging more, they may seek out non-bank sources for credit, right? So if banks lose 20% of their deposits, and they want to continue their lending activities at previous levels, they'll probably have to issue long-term wholesale debt, and that's what will make the loans they're making to the real economy more expensive. Think about that for a second. Their model is calling for a 20% displacement of deposits currently held by the legacy banking system. Can you imagine a bank CEO getting up in front of the shareholders and telling them, hey, by the way, no big deal, let's not make this weird, but we might lose 20% of our deposits? That's a pretty big deal. So the Bank of England is thinking about this as a transition period, right? And to be clear, they say there's a lot of unknowns here. This is a scenario, right? Because they don't have a crystal ball. They don't actually know what's going to happen. But this is the scenario they're reporting on, which tells me they think there is a chance worth looking at that this could happen. I would say a significant chance. So the Bank of England says only when the new digital money emerges will the implications of all this become clear. And here's where it gets really crazy. So they think there's going to be this transition period where like 20% of the deposits in the legacy system leave, right? They migrate to, other places, crypto, right? So here's where it gets pretty wild. The bank says the bank and other authorities may wish to limit migration so the financial system can adjust in an orderly fashion. So that is very polite language. They may wish to limit migration. So if you are a bank and you want to limit migration from the current banking system, to all this stablecoin nonsense, how do you accomplish that? The way you accomplish that is through regulation of those stablecoins. They say, unless adequately regulated, stablecoins could undermine confidence in money and payments in the financial system as a whole. They're telling you straight up, they believe unless they adequately regulate stablecoins could undermine confidence in money and payments in the financial system as a whole. Make no mistake about it, they are using the strongest possible language to tell you they are going to regulate stablecoins. If you are thinking about DeFi projects in the Cardano ecosystem or elsewhere, you need to consider this. What are the chances your small DeFi project survives if it is reliant on stablecoins versus other things in the universe, right? Like central bank digital currencies, right? Is your what are the chances? What are the chances, right? That what are the chances that the stablecoin used in the small DeFi project you're interested in? What are the chances that stablecoin gets to survive in this heavily regulated environment versus a central bank digital currency? Or even let's look a little bit into the universe of stablecoins, private stablecoins. What are the chances that the stablecoin used by your DeFi project is going to survive versus USDC, right? That's got big players like Coinbase behind it. What are the chances that stablecoin gets to survive? And you might try to make the argument, hey, DeFi doesn't even really need stablecoins. But think about it. When the whole market shifts towards a bear market, right? We've seen this time and time again in crypto. In crypto, we have this stock to flow 4-year model, right? And it seems like every 4 years, we get this big dip down, and the whole ecosystem, all of crypto, the whole space, you know, all the values shift downward. And what does everybody want in that scenario? What does everybody want? They want to shift from crypto back to fiat, right? It's like everybody's moving, trying to get out of crypto and into fiat because they can tell the whole space is moving downward. And the opposite is also true. When the entire space is moving upward, what people really want is to move from fiat to crypto, right? They want to move from exposure to fiat into crypto and vice versa. The way we get exposure in a lot of cases in DeFi is through private stablecoins, right? DeFi, sure, there are definitely uses of DeFi to go between coins. But ultimately, how useful is that if there's no exposure to actual fiat currency? You could say, oh, I just want to trade between ADA and this universe of Cardano-based native assets. Sure, that's definitely a thing that happens. But on a much if you zoom out on a larger time scale, what really happens in crypto is the entire market often moves up and down. And when that happens, people want to move in and out of fiat, right? That's where they go. When the entire market's going down, they go to fiat or fiat exposure. And that sort of necessitates stable coins in this DeFi context. If you can't do that in DeFi all of a sudden, if in DeFi there's no such thing as exposure to the dollar, then it's a much different landscape than the current one we're in. So exactly what kind of regulation are we talking about here? Luckily, the Bank of England tells us exactly what the Financial Policy Committee expectations laid out in 2019 Q4 were. They say the first big area of expectation is payment regulation. They say critical links in the payment process must be regulated by the bank, and the current regulatory framework will work here. So if we think about what the current regulatory framework for banks is on payment regulation, a big piece of what we're talking about is KYC, right? Know your customer rules. This is, again, very, very different than DeFi, right? In DeFi, one of the things that everybody loves about DeFi is that you can go into some kind of DeFi dApp environment and, swap coins or make loans or get loans. And there's not necessarily any KYC at all going on there. What the Bank of England is telling us here is that they're going to apply their current regulatory framework to all types of payments, right? And the word payment could encompass any movement of money, basically from one account to another. And they're going to apply their current regulatory framework. And, the current framework heavily relies on KYC. So if there are stable coins moving around in DeFi, maybe all the accounts of those those stablecoins are traveling from and to have to be KYC'd. That's a gigantic change from the current landscape. They also talk about money regulation of stablecoins just in general. Uh, they say that certain key features of the current banking regulatory regime would need to be reflected here, but that I read this as saying they're going to have to lay out a whole new framework for money regulation of stablecoins, but that they're going to try to reflect certain aspects of the current banking regulatory regime. These include legal claim, capital requirements, liquidity requirements, and the need for a backstop to compensate depositors in case of failure. This sounds pretty familiar, right? When we think about these piece by piece, legal claim. So legal claim is very interesting because in crypto, we're very accustomed to this idea of code as law, which doesn't operate in all cases, even in crypto, but basically having the private keys to crypto amounts to ownership of crypto. I think with legal claim, we can kind of, that makes me think maybe we're saying bye-bye to code as law, keys equal ownership, all those kind of concepts that are very central to, all things in crypto, including stablecoins right now. Capital requirements. We already see this in Wyoming. In Wyoming, the speedy crypto banks have to be 100% backed, right? They are not allowed to do fractional reserve banking. They have to be 100% backed. They actually have to have all the funds that they're dealing with. Liquidity requirements and support from the central bank, right? The third item listed here. I mean, they are not imagining DeFi projects that are not working in conjunction with them as the central bank, right? They're going to have these liquidity requirements, which will, and support from the central bank during stress, right? If there's some kind of liquidity crunch, it's fully expected they're going to have this working relationship with the central bank to help alleviate some of that liquidity stress, just like current banks, right? They're going to have a close relationship with the current banks. And they also say that these stablecoin institutions would need a backstop to compensate depositors in case of failure, right? This is kind of like FDIC insurance. Like what they're describing here are banks. Right? Which of your DeFi projects you're interested in would meet those types of requirements today, right? Probably none. All the DeFi projects we talked about in Cardano and elsewhere, probably none of them would be able to meet those requirements today. And the road to trying to meet those requirements would be much more readily met by a current bank moving into crypto DeFi than by a current DeFi project trying to meet those requirements. So that's not looking good. All these things, if the central banks act on the kinds of ideas that are laid out in this Bank of England report, things are not looking too good for currently existing DeFi projects. They would have to undergo this transformation, which would probably make them look pretty similar to modern banks. You have to ask yourself, what's more likely? They actually go successfully complete that transformation, or that modern banks, current legacy banks, sort of take over, that portion of business being done by these current DeFi projects. I mean, I think it's pretty easy to make the argument that those legacy banks are a lot cozier and accustomed to working with this level of regulators than any of these DeFi projects definitely are. The one ray of light I would point to here, though, is that a lot of these regulations are going to require things like KYC. I think Cardano is uniquely situated in that they've been thinking about this for a long time, and they've gone to great lengths to secure digital identity functionality for the Cardano blockchain. In fact, we've already deployed it in the real world with the Ethiopian Ministry of Education digital identity solution in Atala Prism, right? We already have this asset agnostic digital identity solution in Atala Prism, right? Charles recently said in I think it was in the Lex Friedman podcast, he pointed out that a tall prism can work for any asset, right? Any asset you want to create, a tall prism can do the digital identity, attached to that asset. So I think Cardano is well situated to capitalize on whatever regulation comes into the stablecoin space. But I think the DeFi in general in crypto is very unprepared for the amount of the amount and types of regulation that could come around. I mean, I'm sure they're monitoring this kind of stuff vigilantly as anybody else, but for them to comply with the kinds of regulations that the Bank of England is talking about, I mean, this is like a whole cloth transformation of these DeFi projects. And I don't know if it's likely that they're able to make that transformation. So this helps explain some of the lack of coverage of DeFi projects on this channel, because I think the regulatory future for a lot of those projects is possibly very stormy. Talk to you tomorrow.